You may have already heard of what the US is calling One Big Beautiful Bill, a 1,000-plus page document seeking to make many changes in the US, but you may not know how this could impact you. Because one specific section will likely apply to Canadian investors, forcing them to pay a higher percentage of their investment returns on investments that they've already made. This could result in individual Canadians losing thousands of dollars that they would have otherwise been able to pocket personally. To be clear, you're going to want to listen to all of this, especially if you're a Canadian who's invested in US-based assets, specifically interest-bearing assets, US real estate, both rental or personal, and the thing that likely applies to the most people, any US stocks that pay out dividends, which could include Canadian ETFs that pay dividends out from the dividends they receive from their US stocks inside that exchange-traded fund. This is going to impact a lot of people. Don't worry, I'm going to break it all down. Let's go over what this is, why it's happening, when it could come into effect, and most importantly, how much this could cost you. This is the Act, and its short title is cited as the One Big Beautiful Bill Act. As of right now, things are subject to change inside of this bill. Right now, it's passed through the House, but not through Congress. So language could change in here, but I'm going to give you the most up-to-date information as it is right now. This bill is changing hundreds of things, but the only one thing that really heavily impacts Canadians, that is this Section 899, known as Enforcement of Remedies Against Unfair Foreign Taxes. In short, the US is saying that they'll be imposing an increased withholding tax on certain countries who they feel are discriminating against the US with their own taxes or policies. Now, we'll get into why Canada falls into this category in just a moment. Now, if you're not already familiar, for US investments made by Canadians, there's something called a withholding tax. Let me explain. Here are the basics. It skips over some intricacies, but this will give you a good idea. Let's say you made an investment in a US stock of $1,000, and that stock pays out something called a dividend or some sort of return that you get back on top of the growth up or down of the stock's value. For the purposes of doing math, let's say that this dividend payment is 10%. So on that $1,000 investment, you would earn a dividend of $100. But that doesn't immediately go to you. First, there's something that's taken out of it called the withholding tax. To make things simple, it's essentially the IRS, the equivalent of the CRA in the States, saying, well, we know that this money is leaving the country now, it's going to some foreign individual, but we want to make a little bit of money on it too, so we're going to take 15% of that and we're just going to hold it back here to make sure that we're getting our fair share. So in this example, $15 would go to the IRS, and then you would end up getting $85. But unfortunately for you, the Canadian citizen, you've also got to pay tax on this to the Canadian government. Let's say your personal tax rate was 30%. The Canadian government would say, hey, we saw that you just made $100 from this dividend. You're going to have to pay us $30 here on your annual income taxes. But there is something nice that goes on. There's something called a foreign credit, a foreign tax credit. Essentially, the government of Canada is saying, hey, we know the IRS already took 15% of this, so you can reduce this 30% rate by this 15%, essentially. I'm oversimplifying here, but this is essentially how all of this works. This prevents double taxation. Even though the Canadian government wants 30% of your $100 dividend gain, well, they're going to recognize that you've already paid 15% of that to the IRS, and this will reduce down to 15%. It stops double taxation. But this is where things change. With this One Big Beautiful Bill in Section 899, this withholding tax will be increasing at a rate of 5% per year, up to 20% of an increase from what the previous withholding tax was. Inside the bill, they say that for any of these discriminatory foreign countries, of which Canada will likely be included, I'll explain that in just a moment, well, once that happens, we're going to increase your withholding tax by 5%. And any one-year period after that will be an additional 5 percentage points. They go on to say that this would reach a max of 20% on top of what the previous withholding tax was. The big problem is that these increases likely won't be made up for by increases to your foreign tax credits. Instead, it's likely that you'll have to pay these increases directly, with the CRA not giving you any kind of relief. I'll explain these details in just a second, but first I want to take a second to thank the sponsor of today's video, and that is Moomoo. There's been a lot of buzz recently about shifts in US trade policy. There's new tariffs or reworked trade agreements, a fluctuating dollar. Now, recently, amidst optimism that the tariffs will be more short-lived than expected, US markets are rebounding dramatically. This is something that can significantly impact Canadian investors over the short and medium term, while taking advantage of the opportunities like this that the volatility creates. Not only does Moomoo have an extremely competitive currency exchange rate, which we'll talk about more in a moment, also they equip you with the right tools to cut through the noise and spot what's going on and what actually matters for you. That's where Moomoo's new AI features come in. Moomoo Canada has introduced a suite of AI-powered tools that can help you stay on top of market shifts, whether you're trading actively or just keeping an eye on your long-term investments. First, there's AI Summary. Every day it scans all kinds of news sources to deliver a one-page digest of the most important news and market trends. It even includes proprietary trading data like unusual options activity and key technical indicators, and it's all condensed so you can read it quickly. Then there's trend analysis, which uses patterns and recognition from up to 100 similar charts to help predict short-term trading ranges. It's not about telling you the future, but it's about giving you more context so you can time your entries and exits with a little more confidence if that's something you're looking to do. For more technical investors, well, Moomoo also offers technical sentiment, which takes 15 widely used indicators and gives you an at-a-glance view of which way a stock's signals are trending. And to round it all out, we've got Market Monitor. It scans the markets in real time and sends you alerts if you'd like when it detects unusual movement, so you're never left out of the loop. So if you're somebody who loves to stay up to date on what's happening with your investments, or if you'd like to trade a little more actively, these tools can be so helpful and time efficient, giving you more signal and less noise. And the most important thing, all these tools are free when you sign up. And while other popular investing platforms are charging around 1.5% for currency conversion, Moomoo offers one of the most competitive exchange fees in Canada, just 0.09% plus $2. So if you're converting Canadian dollars to US dollars even just twice a year, say $10,000 each time, well, that could end up saving you significant money, around $278 annually compared to these other platforms. And as a bonus, Moomoo gives you free level 2 market data, which some platforms will charge additional fees of up to $90 a month for. That's deeper insight into the order book with no extra cost. So if you haven't joined Moomoo yet, this is the perfect time. New users get some great rewards. Deposit $100 and you'll get $50 cash back. That's a 50% return right away. There's also a transfer in bonus of up to $2,300 in cash. Now, any uninvested cash in your account can also earn up to 6% annual cash rebate through their Cash Plus program. A nice way to get your money working for you while you wait to make your move on an investment. So take advantage while these promos are live. Use the link in the description to check out Moomoo today and see how their AI tools and low exchange rates can help you navigate a fast-changing global market. As I was saying, you'll likely be on the hook for these increased taxes because the CRA likely won't increase their foreign tax credits that they'd be giving you. The 15% withholding tax that currently applies to US dividends, well, after 4 years and the maximum 20% increase, this could look more like 35% withholding tax. Instead of $15 of your $100 dividend being held back by the IRS, instead $35 would be held back. The problem is the Canadian government, well, if your marginal tax rate is 30%, well, we'd say they'd want that 30% still. And they say, okay, well, we remember that our tax treaty has something in it for a foreign tax credit of 15%, but we don't recognize these additionally added withholding taxes. So you're still on top of this $35, gonna have to pay us an additional $15. In this scenario, after tax, you could end up with only $50 of your $100 dividend payment at the end of the day. And it could be even worse than that for you if your marginal tax rate, which it likely is higher than 30%. And this is based on some documents from the CRA. They have section 67.6 here that talks about how you cannot deduct things that are categorized as a fine or a penalty. And they say that this can include a fine or a penalty imposed by, for example, a government or a government agency, regulatory authority, a court tribunal, they go on, but in this situation, it would be imposed by a government or government agency. Furthermore, the government has indicated that any amount of tax you paid to a foreign government in excess of the amount you had to pay according to a tax treaty is considered a voluntary contribution and does not qualify as foreign taxes paid. So, because in the example of this dividend, only 15% is covered under this tax treaty, well, you could only claim a 15% tax write off on this payment to the US, not any of the additional parts that are put on there, because they're not included in the US Canada tax treaty. But this doesn't just apply to US dividends. There are withholding taxes on other types of US investments, including US earned interest, rents or royalties you may be receiving. That could be on a rental property in the States, or US real estate capital gains, which is interesting. The current withholding tax is being shown here, and the new maximums I wrote out here. After 4 years, these are all a 20% increase from the current withholding tax. What's interesting is that this, based on the language currently in the bill, does not apply to US capital gains, gains of things like stocks primarily. If you buy something for $100 and sell it for $200, you had a $100 capital gain there. Right now, it seems that this big, beautiful bill will not be changing how all of that will work, unless you're talking about capital gains for US real property, which includes real estate. The exception being that this could apply to stocks where their primary income, their primary investment goals are real estate based. This could be something like a real estate investment trust. If you make a capital gain on that, well, it's likely that this could apply, and it could apply at this new maximum withholding rate. Now, let's say you don't own any US stocks directly, but maybe you're somewhat of an ETF investor. That's typically the approach that I take, an exchange-traded fund investor, where there's maybe hundreds of stocks held inside of one instrument that you can just buy regularly. Now, if your ETF pays out dividends, and some of those dividends are made from US stocks, well, it's likely that this ETF will now, if this goes through, be paying out a smaller dividend as a result of these new maximum withholding taxes that are going to be held back, and the managers at these ETFs are going to have to deal with that by giving out less to the people who hold those exchange traded fund shares. So you might be asking, well, Russ, what should I do then? Well, I'd say things are incredibly fluid right now, so I'd stay posted. If something major changes, I'll talk about it right here, so make sure to subscribe to the channel if you haven't already done so. But I'd also recommend bringing this up to any tax or accounting professionals that you currently work with. They'll likely also be monitoring this situation pretty closely. And this isn't personal advice, but in my mind, it's not yet the time to take any major actions. But it is the time to start thinking about your options if all of this plays out as expected. Because right now things could change in terms of the language of the bill, or it might not even pass Senate, but it's looking like it's very likely that it will. But now we need to get into the why and the when. Why is this happening to Canadians, and when could it realistically be implemented? This new change will be applying to citizens of countries that are implementing an unfair foreign tax. Now, they list a bunch of things that this includes: an under-tax profit rule, significantly for Canada, a digital services tax, diverted profit tax, and they go on and go on. But we got to look more closely, though, at this digital services tax, because this is something that Canada applies to the US and US companies, something that this change is specifically targeting. The Canadian government implemented this new digital services tax back in 2024, applicable back to 2022. Now, this is a tax that's meant to capture tax revenue that big internet players, big companies collect from Canadians. Now, typically, taxes are paid in the country where that business is located. But Canadian politicians at the time said, hey, that's not fair. It's Canadians that are paying, so a percentage of the corporate tax paid should go to the Canadian government. It should go to us. The US sees this as discriminatory against America because most of these big internet players are, well, in the US. They're US based. So they feel that rules like these are disproportionately taking advantage of US companies when compared to how these taxes apply to other countries. Now, this sounds like something Trump would say a lot, and it certainly is, but it is something that, well, it's not just Trump saying. Back in August 30th, 2024, the Biden administration was making a lot of noise about the adjustment of this digital sales tax, saying that they are going into consult with the Canadian government over the new digital services taxes, saying that it's actually not in appliance with the USMCA or CUSMA or whatever you want to call the trade agreement between the two countries. They say it may dispute a settlement panel under this agreement. So both Trump and the previous administration had big problems with digital services taxes like this. Even though the Biden administration had a problem with it, it does also go with the narrative that Trump has been repeating since before he was elected. And I'll paraphrase. They're essentially saying, for years, we Americans have taxed our citizens to enrich other nations. We're now going to tariff and tax other nations to enrich our citizens. We will create the External Revenue Service. This was the kind of language that you would hear from Trump. Now, they haven't formally created an External Revenue Service to my knowledge, but it's the thought that counts, I guess. And it seems like this new tax change inside of the big beautiful bill is right along these same sort of lines. So you might be thinking, well, Russ, if this digital services tax is the big problem, why don't we just get rid of it? And some people in Canada think that it would be a good idea to do so, but it seems like the current government has a different frame of thinking. Inside the new Prime Minister Mark Carney's campaign platform, there's a section called Tax Fairness, and in it, he talks specifically about these types of taxes. He says that we're going to lead an international effort with partners in Europe and across the G7 to get a fair and consistent set of international tax rules completed, as proposed by the OECD. We will not surrender on rules that ensure large multinational companies pay a fair and consistent share of the profits they earn in a country. This is specifically referring to things like the digital services tax or a global minimum tax. Now, the OECD is a big intergovernmental international organization that's trying to coordinate taxes like these to get a fairer deal in their eyes in their countries. Even though the US is a member of the OECD, other OECD countries are coming together to try to force US companies to pay these types of taxes. So Carney and the Canadian government could eliminate the digital sales tax to avoid the potential billions of dollars lost in investment returns that this could have happen, but it would be seen as conceding to the US's more aggressive foreign economic policy, while at the same time turning their back on the OECD and their partners in Europe, people that they say they're trying to forge tighter connections with. And who knows, this new tax increase could apply even if we were to totally ditch the digital services tax and other taxes like this. Well, it's really subjective right now because they're saying that these unfair foreign taxes, well, that means not only digital service tax and other clearly defined taxes, they're also saying that this could be any other tax that's enacted with a public or stated purpose indicating the tax will be economically borne indirectly or indirectly disproportionately by the United States persons. Now, that's something that's kind of subjective, and they could keep this new change in place even if we were to eliminate some of the more overt things that this would apply to. Now, you might be wondering, when will this apply? They say that it will happen the first day of the first calendar year, beginning on or after 90 days after this bill passes, 180 days after an unfair foreign tax is applied, or the first date that an unfair foreign tax of such country begins to apply. Essentially, all of this means that if this bill passes, it will be January 1st of 2026. The other element of this that we haven't gotten into is that it could result in increased taxes on the Canadian pension plan, the pension plan that we all pay into whether we like it or not. Now, the CPP, the Canada Pension Plan, is currently exempt from these types of withholding taxes. CPP investments have gone more and more lately into the US, growing to just under 50%. Now, this could have a big impact on the Canada Pension Plan's earnings, their profits. It could reduce those profits. And these profits are extremely important for this plan because it's only partially funded and it relies on these gains, these investment gains, to be able to pay out their future obligations to younger Canadians who might be receiving the Canada Pension Plan 20, 30, 40 years down the line. Now, maybe the Canadian government would actually see this as a good thing. Chrystia Freeland and Justin Trudeau just a year ago were heavily musing about considering forcing these pension plans to invest more here at home in Canada to grow the Canadian economy, even if that meant lower investment returns. But now that might happen as a result of this bill anyways, if it goes through. So stay posted. Things could change. Language could change inside of this bill. I'll let you know. Subscribe to the channel. It's already a pretty big deal. Who knows? It could also end up applying to normal capital gains if the language is changed. That would make it even more impactful. I'm curious what you think about all this. What should we do? Should we drop this digital services tax, and should we sort of concede to the Americans on this point? Or is there something else that we should do to handle this situation? Is it going to impact you directly? Let me know what you think in the comments. And with all of that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.